Hi class, welcome to my home. I'm sitting in my command module, if you will, at the kitchen table, which I've moved into preparation for doing online teaching. So I'm having to eat somewhere else, my wife and my son. And so just wanted to put a little bit of my own flavor in the course and do a few videos that will, if nothing more, be review for you and put my kind of teaching style and add that to supplement the Pearson lecture. The Pearson lectures, I haven't watched them all. I know you're watching them, hopefully. I have heard they're exceptional, and they will do a really great job of taking you through all the materials, probably better than me. But still, I like to, bring my own personality and style into the course and for you and to help you learn. So these are going to supplement, hopefully be a review for our next exam, which will cover chapter 6, 7, and 9, 25 multiple choice, online, open book. Man, that my prior students would have really enjoyed an open book exam, which I would never have allowed. So got open book, open notes. It's going to be a little tougher than a normal exam. You're going to have to really know the materials. There's going to be some quantification that's got to be done. And so that's also why I thought it might be a good job to do some of these videos and talk about inventory for chapter 6, property, plant, and equipment for chapter 7, and then funds payable for long-term liability. So let's start with inventory. This lecture today is just on inventory, and so I'm going to share my screen here and get started. Let's see, right here we go. I bought a visualizer, so I can be just like I can be just as bad here at home that I am in class. And so, again, I always say accounting's about measuring and about reporting, and I just don't want you to forget the reporting side and the purpose of all this that we're doing on inventory. And so, eventually, we're going to provide a balance sheet and an income statement to people that are interested in our business, owners, creditors, maybe employees, if they have access to see this, it'd be very interesting to them. So we're talking inventory. So we're going to buy inventory. That's going to be products that we own for one single purpose, to sell to our customers. And when we no longer own this inventory, the day we sell it, it's going to move into an expense, cost of goods sold. So our revenues are going to be the units we sell times the price we sell them for. The cost of goods sold are going to be the units we sold to those customers, matched up 100% with revenues times the cost. We're going to take revenues minus cost of goods sold, and we're going to calculate gross profit. And that's going to tell users of these financial statements a lot about the business. If you have a very high gross profit, means that you're able to buy stuff at a low price, low cost, and sell at a high price. Man, isn't that's what business is all about. That's why this is my favorite chapter in the entire course, because companies are buying stuff at low cost and selling it at a high price. Successful companies are doing that. And you see that right in this gross profit, a very important number. So we're going to have one thing, one formula here to calculate cost of goods sold that's very important. And so, and again, I know you've seen this probably in the Pearson lectures, but I'm not to belabor it, but let's just take a look at it. So we're going to have beginning inventory, the inventory we start with, and then during the accounting period, remember accounting period could be a month, it could be a year, whatever period we're doing the accounting for, we'll take all the purchases of inventory during that accounting period, and we'll add it to the beginning inventory. So what do we have here? We have available for sell inventory. And then we're going to go out and count how much do we have left at the end of the accounting period, and we're going to subtract that out. That's the ending inventory. The ending inventory, by the way, that's going to be the amount that's going to show up on our balance sheet. Products that we still own. The balance sheet represents things we own. The things that are missing between what was available for sale and ending inventory, that's amounts that we sold. And so available for sale minus ending inventory equals cost of goods sold. You might remember in class, I made that easy, and I'll do it again here just quickly. You know, we said we had 3 units that it was beginning inventory, and we went out and we bought 7 more units. So how much did we had? We had 10 units available for sale. We go out there at the end, there's only 2 units left. And so how much are missing? 10 minus 2, 8. So there's 8 units that were sold. Now here's the problem that we face. When the inventory we start with and the inventory we buy and the inventory we end up with, they might look exactly alike and be the same exact units, but they're going to cost different at different prices. We're going to buy them at different prices, and we're going to be left. And we don't know which ones they are because no one tracks every unit out there. Let's say oranges at Kroger. They don't know. Some of those oranges cost them 50 cents. Some cost 75 cents. Those orange prices are probably changing every day. They don't know what it is. So we have to use some assumptions in accounting. The first assumption that we could use, companies pick an assumption and stay with it, would be FIFO, which is first in, first out. Second assumption could be LIFO, last in, first out. Or we could just use, hey, the average cost method. We look at all the average costs of the units in available for sale, and we use that to quantify cost of goods sold in ending inventory. So let's go look at an example. It all gets down. Let's look at an example. So let's do example 1, first chair. You remember we did these in class, so this is nothing new for you, just going to be more of a refresher than anything else. So we started with beginning inventory of 500 units, and they were cost us $5 each. So let's just get this on the sheet here. 500 units, each one cost $5. So the total cost was $2,500. That's how much we started the accounting period with. On the 10th day of the month, we bought 500 more at, guess what, $5 each. So, so far, so good. We're at the same cost. However, on the 20th day of the month, we buy 1,000 units, and guess what? They're costing us $10 each. And so 1,000 units, we had some significant inflation there. And the value of that was 1,000 times 10, $10,000. And then on the 25th day of the month, we bought another 1,000 units. This commodity, whatever this is certainly increasing in price right during the month. Experience that in business. That happens all the time. And how much was that cost us? 1,000 times 15, 15,000. So total purchases, 2,500 units, 500 plus 1,000 plus 1,000. Total cost was 25,000, 27,500 in the total cost. So beginning inventory plus purchases equals available for sale. So we had 500, bought 2,500 more, 3,000 units available for sale, and they cost us 2,500 plus 27,500, $30,000. Now, and that's the truth whether we're doing LIFO or average cost. That's going to be the same. I'm going to just fill that out. That available for sale is not changing here. What we now have to do is value the ending inventory on these 3 different assumptions. First in, first out. Okay, the first one's in, the beginning inventory, they're gone. So we had 3,000 available for sale. We're looking for, by the way, 1,000 in ending inventory, and I'm pulling that. Ending inventory equals 1,000 units. And so units sold were 2,000. But which 1,000 are left? Under FIFO, first one's in, first one's out, they're the last ones. They're still there. So those 500, they're gone. Those 500 are gone. Those 1,000, these 1,000 under first in, first out are still there at 15. So under FIFO, we calculate the cost per unit at 15. So 1,000 times 15, 15,000. Cost of goods sold under FIFO, $30,000 minus $15,000, $15,000 cost of goods sold. And I came over here, I did this earlier. Revenues were 40,000. Where did I get that? The company sold 2,000 units times $20 each. 2,000 times 20, revenues were 40,000. So under FIFO, revenues of 40,000 minus cost of goods sold of 15,000, gross profit was 25,000. And this is under FIFO. Let's put this up here because we'll come over and do LIFO next. Let's look at the difference there. So under LIFO, the ending inventory, last ones in are the first ones out. So these 1,000 under LIFO get sold. Is that what happened in reality? No, we don't even know. We just use this mathematical assumption, and we tell investors, hey, we're under the LIFO method. And so they know that. And so these last ones in, they're gone. Hey, those 1,000, they're gone. And so I'm looking for 1,000 in inventory. What's the beginning inventory and the first ones we purchased under last in, first out means, hey, those first ones we bought, they're still there. And so we have this 1,000 and they were both at $5. So 5,000. And so cost of goods sold, 3,000 units minus 1,000 units, 2,000 units. And then available for sale, $30,000 under LIFO, but the inventory is only valued at 5,000. So my cost of goods sold is 25,000. So under LIFO, revenues don't change. What customers pay, they don't care how we account for the inventory. They paid 40,000. Cost of goods sold was 25,000. And look at that. Gross profit is less under LIFO. Why? Rising prices. Under increased pricing, LIFO will give you a smaller profit. That's why LIFO basically primarily comes about because people want a larger tax deduction, and they can pay less taxes under LIFO under rising prices, and mostly we experience inflation in rising prices. So finally, let's look at the average cost method, really the easiest one. So what's the average cost in available for sale? $30,000 divided by 3,000 units, $10. So we take our ending inventory at the average cost of $10. 1,000 times $10 equals 10,000. We sold 2,000 units. 30,000 minus 10,000 is $20,000 in cost of goods sold. Guess what? Hey, they're both valued at $10, 20,000. That makes sense, right? And so there's all three methods for valuing inventory. And you're going to have problems on the exam. And I think some of the questions on the exam have more than 3 purchases. So you'll have to really track that and understand it. Let's do one more problem. And then there are 4 problems on Canvas in Excel, but I'm gonna work through this a little quicker since now you know what we're doing here. What you could do right now, hey, pause the video, go work this on your own. Right here, here's example 4 facts. I'm gonna work it. Pause the video, you go work that, and just see if you get the same answer I do. All right? So here, pause for a second. All right, you're back now. All right, here you go. Example 4, beginning inventory, 500 units at $10 each, $5,000. By the way, that was what was on our balance sheet at the end of the last accounting period. Now, on the 10th day of month, we bought 500 units at $15 each. 15 times 500 is 7,500. On the 20th day of the month, we bought 500 units at $20 each. 20 times 500, 10,000. And the 25th day, we bought another 500 units at $25 each. And that multiplies out at 12,500. Let's add down. What were our purchases? We bought during the accounting period 1,500 units. And then what were the cost of those units? It would be 7,500 plus 10,000 plus 12,500, $30,000. Now, what's available for sale? 500 plus purchases of 1,500, 2,000, and that's going to be true in all three methods available for sale. Again, available for sale, beginning inventory plus purchases. And dollar amount still going to be same, 5,000 plus 30,000, 35,000 in all three methods. Now, ending inventory is told, just like last time, no, ending inventory is 1,000 units. And so we sold 1,000 units. The problem is these 1,000, which ones are they? Are they the $10 ones, the $15, 20 or 20? We don't know. We really honestly don't know. So we just use the assumption that our business uses. And so let's do FIFO first. So these 1,000, they're the ones that are still, that we bought recently, because the first ones we bought, they're the first ones out. So those 500 are gone. It's these that are still there. We have 500 times 20 and 500 times 25, 10,000, 12,500. We add these two together and we get 22,500. So available for sale, 35,000 minus ending inventory under FIFO, 22,500, and the cost of goods sold is going to be 12,500. Let's do LIFO. Under LIFO, this is really straightforward stuff, guys. You can just knock this out on the exam. I'm totally confident you guys will do well. Now, under LIFO, the ending units of 1,000, they are the, let's see, last ones in are the first ones out. So the last ones in, the first ones out. Which one are still hanging around? The first ones. 500 at 10 and 500 at 15. There's where our 1,000. They were the ones from the beginning of the period and the first ones we bought, because the last ones we bought, they're the first ones out, LIFO. And so that's 5,000, 7,500. We add that up and we got 12,500. What was cost of goods sold? 22,500. Higher cost of goods sold. Why? Rising prices. Inflation results in a higher cost of goods sold and then therefore a lower gross profit, a lower net income under LIFO. And then we pay income taxes based on income. Therefore, we pay less taxes. That's why a lot of businesses use LIFO, because they want to save money on taxes. And then finally, average cost is easy. $35,000 divided by 2,000 units. Each unit in available for sale is worth $17.50. So times 1750, 17,500. 35,000 available for sale minus ending inventory of 17,500. That also equals 17,500. Don't forget gross profit, because that's what we're trying to do here. We'll end with gross profit on this. And again, gross profit equals revenues minus cost of goods sold equals gross profit. Let's do it under FIFO and under LIFO. I'll skip the average cost just in the interest of time. We sold 1,000 units times $50 each. So our revenues on our income statement are going to be $50,000, both under LIFO and FIFO. My cost of goods sold, I come back over here under FIFO, is $12,500. Therefore, I've got a $37,500 gross profit. And if I take $37,500 divided by 50,000, I don't have my calculator here, but I'm pretty sure I can say that's a 75%. 37,500 divided by revenues. So a lot of people also care about gross profit percent. And that's just gross profit divided by revenues and gets us into percentage terms. Let's look at LIFO then, $50,000 in revenues, but I had $22,500 in costs. And therefore, did I do something wrong here? Therefore, my ending inventory is $27,500. What the heck am I? Yeah. My gross profit, I'm sorry, got a little confused there. 50,000 revenues minus 22,500. My gross profit is 27,500. And let me just grab my calculator here and make sure I got these all right. If I can find it, I use my phone calculator. Make sure I don't screw this up. All right, here we go. All right, 27,500 divided by 50,000, 55%. So the gross profit under LIFO is lower, 55%. Why? We had increased pricing. We had inflation. So there you go, guys. That's an inventory. That's chapter 6 in a nutshell. You're just going to have just a multitude of multiple choice around this concept, just like this. So, and some available for sale calculations, some gross profit calculations. And I know you can do it. This is to me, one of the most straightforward chapters that you'll do. Guys, thank you very much. I hope that you're healthy and safe again, and we will talk to you soon. Bye.